Welcome to NM Arena. In this video, we are going to discuss regarding the Indian money market. The Indian money market is divided into two sectors as organized sector and unorganized sector. The organized sector comprises of the Reserve Bank of India, SBI Group, and the commercial banks, foreign, public sector, as well as the private sector banks. The financial institutions also participate to a limited extent, and the unorganized sector consists of the indigenous bankers and the money lenders. The organized money market in India has a number of sub-markets such as the treasury bills market, commercial bill market, interbank call money market, etc. Major players in the Indian money market includes the Reserve Bank of India, financial institutions like IFCI, IDBI, ICICI, IRBI, LIC, UTI, etc. The commercial banks including scheduled as well as non-scheduled commercial banks, private banks, foreign banks, State Bank of India and the cooperative banks, etc. The Discount and Finance House of India or the DFHI, the brokers, provident funds, public sector undertakings, corporate units, etc. All these have a major role to play in the Indian money market. Let us discuss the defects of the Indian money market. The most important defect of the Indian money market is the existence of the unorganized segment. In this segment of the market, the purpose as well as the period are not clearly demarcated. In fact, this segment thrives on this feature. This segment undermines the role of the RBI in the money market. The efforts of RBI to bring the indigenous bankers within the statutory framework have not yet yielded much result. Another important deficiency is the lack of integration of different segments or the functionaries. However, with the enactment of the Banking Companies Regulation Act 1949, the position has changed considerably. RBI is now almost fully effective in this area under various provisions of the RBI Act and the Banking Companies Regulation Act. There have been too many interest rates prevailing in the market at the same time, like borrowing rates of the government, lending rates of commercial banks, rates of cooperative banks, and rates of other financial institutions. This was basically due to the lack of mobility of funds from one sub-segment to the other. However, with the changes in the financial sector, the different rates of interest have been quickly adjusted to changes in the bank rate. A notable feature is the seasonal diversity. There are very wide fluctuations in the rates of interest in the money market from one period to another in the year. Like November to June is the busy period. During this period, the crops from rural areas are moved to cities and other parts of the country. And the wide fluctuations create problems in the money market. RBI attempts to reduce the seasonal fluctuations in the money market. Indian bill market is an underdeveloped one. A well-organized bill market or discount market for the short-term bills is essential for establishing an effective link between the credit agencies and the RBI. And the reasons for the situation are historical, like preference for cash to bills, etc. Till 1969, the branch expansion was very slow. There was a tremendous effort in this direction after nationalization. A well-developed banking system is essential for a money market. Even at present, the lack of branches in rural areas hinders the movement of funds. With the emphasis on profitability, there may be some problems on this account. And on the total, we can say that the Indian money market is relatively underdeveloped. In no case it can be compared with the London money market or a New York money market. There are a number of factors responsible for this in addition to the above discussed factors. For example, lack of continuous supply of bills, a developed acceptance market, lack of a commercial bill market, then the dealers in the short-term assets and lack of coordination between different sections of the money market, etc. The Reserve Bank of India has been making efforts to remove the defects of the Indian money market. The organized sector of the market is relatively well coordinated and the differences between various sectors of the market have been reduced. The bill market scheme was an important step in this regard. Let us see the other reforms in Indian money market. The Reserve Bank of India has played an important role in the introduction of new money market instruments like 182 days treasury bills, longer maturity bills, certificate of deposits, commercial papers, etc. The deregulation of interest rates helps the banks to accustom to better pricing of assets and liabilities. And the post-reforms period saw significant institutional development and procedural reforms aimed at developing a strong secondary market in the government securities. Discount and Finance House of India has been set up as a part of the package of reform in the Indian money market. It buys bills and other short-term papers from the banks and financial institutions and provides the short-term investment opportunity to the banks. The institutional infrastructure in government securities has been strengthened. The money market mutual funds was set up in 1992 and it announced to bring it within the reach of individuals. These funds have been introduced by financial institutions and banks. With these reforms, the money market is becoming more vibrant. There is further scope by introducing new market players and extending refinance from the RBI. And the Narasimham Committee has also proposed that well managed non banking financial intermediaries and merchant banks should also be allowed to operate in the money market. As and when implemented, this will widen the scope of money market. Then the foreign institutional investors are allowed to operate in all dated government securities. These are the major reforms in the Indian money market. So that's all about the Indian money market. Thank you for watching this video. For more videos, subscribe the channel.